If you've been into crypto long enough, you'll remember when the entire institutional conversation was all about Bitcoin, Bitcoin ETFs, Bitcoin treasury strategies, Bitcoin as digital gold, and Bitcoin replacing gold reserves. That was the narrative. If a public company wanted crypto exposure, the answer was simple: buy crypto. That was the institutional playbook. Michael Saylor made it famous. MicroStrategy made it mainstream. And suddenly, every boardroom, every CFO, and every treasury department started asking the same question: should we be holding Bitcoin on our balance sheet? But something has quietly started changing, and honestly, I think most retail investors have completely missed it, because now major corporations are allocating not just Bitcoin, but Ethereum. And that matters far more than most people realize, because when institutions move beyond Bitcoin and start seriously looking at Ethereum, it signals something much bigger than just another crypto headline. It signals the next phase of institutional adoption in my eyes. So today we're breaking down why corporates are quietly adding Ethereum to their balance sheets, why Ethereum is being viewed differently from Bitcoin, and why the shift could become one of the biggest financial stories of this cycle. Because this isn't just about Ethereum. It's about how traditional finance is starting to think about crypto as actual infrastructure, not just speculation. And trust me, this gets very interesting.
I am not a financial advisor. This video is based solely on my opinion on what I'm personally doing in this market. I also want to let you know that some of the links below and in the descriptions are affiliate links, meaning I may get a commission, but it will be at no extra cost to you. Please remember that under no circumstances will I ever contact you and ask you for investments. You can confirm all of my real social media handles in the description and also at milkshakematty.com. This content is for educational and entertainment only, and I'm not a financial advisor.
Before we dive in, a quick reminder: if you're serious about learning how to actually make money in crypto, not just watching headlines and hoping for the best, I've created something specifically for you. It's called the Free Crypto Liftoff course, and inside I show you the exact strategies that I've personally used to make money through multiple bear markets and bull runs. This is not one of those fake free courses where halfway through you suddenly get asked to pay a fortune for real secrets. There's no upsells, there's no nonsense, there's no hidden catch. It's genuinely 100% free, because I wanted people to have access to real education, especially in a market full of people trying to sell you dreams. If you want access, simply visit cryptowolfpack.co.uk or click on the link in the description. Go grab it. Right, let's get into this. So this all started from a Yahoo Finance article asking a very important question: why are more corporates allocating Ethereum to their balance sheets? And honestly, that question alone should make people stop and think, because for years, institutions have treated Bitcoin as the safe crypto. Bitcoin was simple. Bitcoin was easy to explain. Bitcoin was digital gold. It had one job: store value. That made it easy for CFOs, hedge funds, pension funds, and public companies just to justify holding it. You didn't need to explain smart contracts. You didn't need to explain staking. You didn't need to explain DeFi. You just said it's like gold, but it's digital. Easy, clean, simple. And Wall Street loves simple. But Ethereum is different. Ethereum isn't just a store of value. Ethereum is a productive capital. And that changes everything for them, because when a CFO looks at Bitcoin, they see a reserve asset. But when they look at Ethereum, they see a reserve asset plus yield, plus infrastructure, plus future financial rails. And that is a completely different conversation. And that is why this matters. Let me explain. Bitcoin just sits there and Ethereum goes to work. Ethereum can be staked. That means companies can hold ETH and generate yield from it. Now suddenly treasury management becomes much more interesting. Instead of just holding an appreciating asset, they can hold an appreciating asset that also produces income. Traditional finance absolutely loves yield. Banks love yield. Funds love yield. CFOs love yield. And that is how they think. They are constantly asking, how can this asset improve efficiency? How can it reduce costs? How can it generate returns? And once Ethereum becomes a treasury asset instead of just a speculative asset, the institutional conversation changes massively for them. Because now it isn't, should we buy crypto? It becomes, which crypto solves a specific business problem? And that is a giant shift. And honestly, that shift is where the real money gets made. Because once finance stops asking if, they start asking how much. And that's when things start to get serious. Now let's talk about the companies already doing this, because this isn't just theory. This is already happening. Companies like Coinbase, SharpLink, Bitmine have all been building major Ethereum treasury positions. Some are holding ETH as a reserve asset, and some are actively staking it for yield. Some are building broader treasury strategies around it. This is not some future prediction. This is live right now. Finder reported that by late 2025, Bitmine had become one of the largest public corporate ETH holders. That should tell you everything. This is not a random retail speculation. This is a strategic capital allocation. And once public companies start doing something successfully, others will follow. That's how institutions work. Nobody wants to be first, but everybody wants to be second. That is just finance. Nobody wants to be the crazy person who bought too early, but everybody wants to be the genius who got in at the right time. And that is how capital moves, slowly, then all of a sudden, quickly. And here's where things get even bigger. Because Ethereum isn't just about treasury reserves. Ethereum sits at the center of tokenization, stablecoins, DeFi, settlement rails, on-chain finance, real-world asset infrastructure. This is where Wall Street starts paying very serious attention. Banks are not interested in crypto because they suddenly became crypto bros. They care about efficiency, they care about speed, they care about reducing friction, and they care about freeing up trapped capital. And blockchain infrastructure can do exactly that. Faster settlement, lower counterparty risk, reduced operational costs, and improved treasury management. That's where trillions of dollar decisions get made. Not hype, but on efficiency. And Ethereum is right in the middle of that conversation. This is why treasury adoption matters. Not just about holding ETH. It's about participating in the next financial infrastructure layer. That is the real story here. But, and this is important, this isn't all bullish sunshine. There are real risks here. And if you ignore them, you will get wrecked because corporate treasury strategies can go very wrong, very fast. Let's talk about the dangers. Well, first, you've got the volatility. Ethereum is still volatile, massively volatile compared to traditional treasury assets. A CFO cannot explain a 40% drawdown the same way a retail investor can. That creates balance sheet stress, it creates shareholder pressure, and it creates boardroom panic. And traditional finance does not like panic. Second is debt-funded buying, and this is MicroStrategy's model. They borrow money, they buy crypto, hope the number goes up, and it works brilliantly until it doesn't. If the price drops aggressively, leverage becomes dangerous, and it becomes dangerous real fast. And when leverage gets dangerous, forced selling begins. That's where people get destroyed. Third is premium collapse. Now, some treasury companies trade at a huge premiums compared to the actual value of the crypto they hold. That works while hype exists, but if that premium disappears, it's pain, and a lot of pain. And we've seen that before because markets can stay irrational for a long time until they suddenly become very rational again, usually at the worst possible moment. That's why this strategy is powerful, but also dangerous. It requires timing, risk management, discipline, exactly like trading, which is why most people get it wrong. And this is where I want to say something important. Do not confuse institutional adoption with guaranteed price action. This is one of the biggest mistakes by new people in crypto. People hear bullish news and assume immediate green candles. That is not how this works. Markets front run, markets overreact, and markets punish weak hands. Sometimes the best news comes right before a brutal correction. That is reality. This is why strategy matters more than emotion. This is why understanding market structure matters more than headlines, because headlines are designed to trigger emotions and strategy is designed to protect your capital. And there is a huge difference between the two. If your entire crypto plan is based on hope, you are already in trouble. You need structure, you need rules, you need repeatable systems. That is what separates traders from gamblers. And honestly, that is exactly why I built the Crypto Liftoff course. Because too many people enter crypto with excitement but no plan. And excitement without a plan becomes expensive very quickly. You need to know when to enter, when to scale, when to take profits, when to protect your capital. That is the difference. And again, it's free. Go and use it. There's a link in the description. Now, here's the bigger macro question. What if this is only the beginning? Because if Bitcoin opened the institutional door and Ethereum expanded the treasury conversation, what comes next? This is where things get huge. Tokenization of stocks, tokenization of bonds, stable coins for corporate settlement, real world assets moving on chain, cross-border treasury movement, instant settlement rails. This is not science fiction. This is already being built quietly by the banks, by payment giants, by governments, and by institutions that move far slower than retail, but far bigger. And once infrastructure starts being built, momentum becomes difficult to stop because institutions don't build these systems for headlines. They build them because they expect them to become standard. That's what people tend to miss. When serious money commits to infrastructure, it's because they expect the future to look different. That is the signal, not the press release. That is capital allocation. That's what matters. Always, always follow the money. This is why I believe the smartest investors are not asking which coin pumps next. They're asking which asset becomes unavoidable. That is the better question because hype fades, but utility scales. And if an asset becomes critical infrastructure, price eventually follows. That doesn't mean tomorrow. That doesn't mean next week, but it matters, and it matters massively. This is why I watch institutional flows. This is why I pay attention to treasury strategies, because retail noise is loud, but institutional movement changes history. That's where the real signal lives. And honestly, most people won't notice it until it's already obvious. That is how every cycle works. The winners position early, the crowd arrives late, then everybody pretends it was obvious all along. It's the same story every single cycle. So my honest take, the headline on the article is bigger than it looks because it said it's not just Bitcoin anymore. Because once corporations accept crypto on balance sheets, they stop asking whether crypto belongs. They start deciding which asset deserves a permanent seat at the table. Bitcoin already has one. Ethereum now is earning one. And if Ethereum becomes the standard productive treasury asset for public companies, the scale of that shift could be enormous. Because then crypto stops being an experiment. It becomes part of corporate finance. And that is a completely different world. And once that happens, there is no going backwards. This is why I think people should be watching this very closely, not just the price charts, adoption, infrastructure, positioning. This is where wealth gets built, not by chasing green candles, but by understanding where the world is moving before everybody else does. That is the real edge. I want to hear from you. Do you think Ethereum becomes the dominant corporate treasury crypto after Bitcoin? Or do you think companies will always stick mainly to Bitcoin? Drop your thoughts in the comments below because I read them all. And if you want to learn the exact strategy I use to navigate markets, remember the crypto liftoff course is completely free. No upsells, no fake guru nonsense, just real education. Go and visit cryptowolfpack.co.uk or hit the link in the description. Also go and check out the new episode of the UK Crypto Podcast, which I host alongside Paula Talks Crypto. We release a new episode every single Friday at 7 p.m. I'm going to link the playlist at the end of this video somewhere above my head so you can dive straight in after this video. And if you enjoyed this video, please smash that like button, subscribe to the channel, and I'll see you on the next one because trust me, the next few months in crypto are going to get very, very interesting.